In this video, we're going to talk about how to do solo 401k contributions. And this is going to be more specific to sole proprietors, single member LLCs, and 1099 contractors. We're going to talk about eligibility. We're going to talk about contributions, deadlines to establish the plan, as well as tax credits that are available for both new and existing solo 401k plans. So the focus of this presentation is going to be about who's eligible to establish the solo 401k plan. What do you need to know about different contribution types? We're going to talk about the benefits of a solo 401k plan, the contribution limits, the deadlines to establish a new solo 401k plan, as well as the tax credits that are available to you. So who's eligible to establish a solo 401k plan? This plan type is eligible for self-employed individuals if you own your own business. And that can be if you're an entity structure as just a sole proprietor, LLC, an S Corp, or 1099 contractor. Now, if you are the spouse of an owner, you can also open up a solo 401k if you are working in the business as well. So that's another great feature. You're kind of doubling up on the contributions here. But you can't establish this plan type if you have any full-time W-2 employees. And full-time means you're working more than 1,000 hours in the business. You do not necessarily need to have a separate EIN for your business in order to be able to set up a solo 401k, but you do need to be reporting some self-employment income on your taxes to be able to set it up and contribute. And you can create your own solo 401k even if you have another day job with a 401k. So this is great. If you have a business on the side, you're doing a little extra work as a 1099, you can still create your own solo 401k plan. Now, it is subject to certain contribution limits. We'll talk about that in our next video. One of the questions I get is, do you need to have a certain amount of income? And the answer is no, you don't need to have a certain amount of income, but you do need to recognize that those contributions are based on the income that you're reporting on your tax return. So you can save more if you're obviously earning more in the business, but you can't save more than what you're showing that you're earning. The amount you're eligible to contribute will likely go up as your income is increasing. And like I mentioned before, you and your spouse or business partner can participate as long as they are reporting their own self-employment income from the business on their tax return as well. So a couple things you should know about contributions, just to get the lingo of what we're going to be talking about. And a lot of people are probably familiar with the terminology of pre-tax or Roth contributions. You see that a lot with employer-sponsored retirement plans. Pre-tax means you take a deduction on your income taxes from the money that's going into that. So you're not getting taxed on any of those contributions. Whereas Roth, the taxes are coming out first. So these are after-tax contributions. And there's benefits to having both. It kind of depends on what bracket you're in to see if it makes more sense for you to do the pre-tax or the Roth contributions. Another great feature with these plans, though, is that they have the ability to make voluntary after-tax contributions. So this is commonly called the mega backdoor Roth contribution. So you're able to make these additional contributions as the employer as well. That's one of the great features of the solo 401k plan is that you're acting as both the employee and the employer. So you're making both sides of these contributions to your own retirement plan. And we'll get a little bit more into the details about each of these different types of contributions. But I just want to set the stage with some of the lingo that we'll be referring to. So what's the benefit of the solo 401k plan? It has the highest contribution limits of any defined contribution plan for self-employed individuals. It's one of the great benefits of this plan. And it allows these self-employed businesses to be able to save for retirement. You're acting as both the employee and the employer when you're making these contributions. And it gives you flexibility to make these year-by-year decisions on how much you're contributing based on your income and profitability. So you don't have to necessarily do the same thing from one year to the next. If you have a high income year, maybe you want to shelter a little bit more from taxes. You might do a little bit more of the pre-tax contributions. If income's a little tight in one year, maybe we're going through economic downturns, money's not as accessible because you're doing some expansion projects in your business. It gives you the flexibility to adjust those contributions year by year. So the contribution limits for a solo 401k plan in 2024 The total plan limit that you can put into your own solo 401k is $69,000. If you're over age 50, you can make catch-up contributions up to $76,500. Now, in 2025, they changed the rules a little bit and actually created some additional features if you're in this sweet spot between ages 60 and 63. So, overall plan limit increased to $70,000 for everyone. And then if you're over age 50, with the catch-up contributions, it's now $77,500. But if your age is 60, 61, 62, or 63, you get to make these super catch-up contributions and kind of super fund it a little more with up to $81,250 as a total contribution with those catch-up to your 401k plan in 2025. Now, where that breaks down as the employer versus the employee, and this is true even if you have another employer-sponsored plan through your day job at your employer, the employee side of that contribution is up to $23,000 in 2024. And if you're over age 50, it's $30,500. In 2025, again, the numbers went up just a little bit. Now the employee contribution is $23,500. If you're over age 50, your catch-up contribution and your employee contributions means that you can go up to $31,000. But if you're in this sweet spot between ages 60, 61, 62, and 63, those super funded catch-up contributions allow you to go up to $34,750. Now, what's the benefit of the solo 401k? Well, it kind of depends on what your savings angle is. So we talked about pre-tax and Roth, and you have the ability to do both. So you can do pre-tax contributions to your retirement plan if you want to save a little bit more on taxes. You can make that as both the employee and the employer, and that will reduce the amount of income taxes that you owe for the year. Now, if you are expecting to be in a higher tax bracket in the future, or maybe you expect tax rates to go up in the future, or maybe there's some other legacy planning angles there, you might be a believer of getting as much as you can into the Roth side of your plans. So if you want to maximize those Roth contributions, you can do that as an employee. The way you would do that is through voluntary after-tax contributions that give you the ability to make those contributions and then convert it to your Roth 401k plan or Roth IRA afterwards. Now, the deadline to set up a new solo 401k plan, this is the important part. The plan documents need to be established by December 31st of that calendar year. But the deadline to fund the account is actually not until the tax filing deadline of the business plus any extensions. So for 2024, if you're a sole proprietor, LLC, taxed as a sole proprietor, that deadline is April 15th of 2025 or October 15th of 2025 if you're on extension. If you are an S Corp or a LLC taxed as an S Corp or a partnership, that deadline is March 17th of 2025 or September 15th, 2025 if you're on extension. Now, this is where we talk about tax credits. So under the Secure Act, there are now tax credits that are available to small businesses that offer a solo 401k plan. And that tax credit is for setting up a certain feature in your plan documents. It's an auto enrollment feature. And that auto enrollment feature makes you eligible for $1,500 in tax credits. And what that looks like on your tax return is you would get $500 per year for 3 consecutive years for having that feature in your plan. Now, this is eligible for new as well as existing solo 401k plans as long as you have this feature in your plan documents. So if you don't have this feature in your documents, this is a great time to make that amendment, get those plan documents updated so that you can take that tax credit for this plan year. Now, it's not based on the actual cost of setting up or maintaining that plan. So it may cost a little bit of money if you need to update those plan documents. You're still going to get the full $500, even if it costs you much less to do that. And you are getting that $500 per year for 3 consecutive years. So that solo 401k plan with that automatic contribution feature is going to look like a default 3% contribution, but you are the business owner. You're the employee as well as the employer, and you get to decide, like I said, have that flexibility of how much you're going to contribute. So you can technically opt out of that 3% contribution and then decide later if you're going to do more or less, or any to your plan. You are not required to make those annual contributions to qualify for that tax credit. And that's an important point to note. You just need to update your plan documents to be eligible for this tax credit. So you want to claim this tax credit by filing Form 8881 on your tax return for the next 3 years. In the next video, we're going to cover what's included in self-employment income and how to calculate those contributions to your solo 401k plan.